Welcome, everyone, and happy Friday. Today is one of those special days for us on the Jack and Bill Show when we get to interview a guest. And I am so delighted by our guest today. I want to welcome Dr. Idanna Appio of First Eagle Investment Management to the Jack and Bill Show. There you are. Welcome.
Thanks for having me.
Thank you for taking the time to join us here in Shreveport. Dr. Appio, you are a portfolio manager, a senior sovereign analyst on First Eagle Investment Management's global value team. You are an expert on sovereign debt and foreign exchange. And prior to joining First Eagle Investment Management in 2015, you spent more than 15 years at the Federal Reserve Bank of New York, finishing your time there as deputy head of the Global Economic Analysis Department. That is a mouthful.
Yeah. Leave it to a bureaucracy to have big titles, right?
Exactly. You have a lot of expertise, and macroeconomics is clearly your wheelhouse, and that's where we want our focus to be today. I really want to pull out of you a lot of your experience from the Fed, because it seems like that is what everyone is myopically focused on. And I guess this really goes back to the financial crisis, because prior to the financial crisis, investors didn't pay a whole lot of attention to the Fed. But ever since, the Federal Reserve has been on the forefront and has played an outsized role in the economy and financial markets. So I'm going to use that as a segue. There's a lot of misconceptions about the Fed. It's kind of viewed as a black box. There's been some interesting things written about it, going back to its secretive foundings at Jekyll Island in 1910. Why don't you start by informing us about the purposes and functions of the Federal Reserve System? Demystify all of this for us, please.
Sure. So under the Federal Reserve Act, which was passed in 1913, the Fed is operated under a mandate from Congress. And it's, I think, what most people hear and know of as the dual mandate. So that includes one, pursuing maximum or full employment, and two, low and stable inflation, which the Fed has defined as an inflation rate that averages 2% over time. Now, although financial stability isn't an explicit part of the dual mandate, in practice over time, it's become a key focus. And I think this reflects the importance that a healthy, functioning financial system has for achieving those employment and inflation goals. Additionally, the Fed, as well as other central banks, play very important roles in operating parts of the economy's payment system, so the plumbing of the system. So if those don't work, the financial system doesn't work, and then the rest of the economy doesn't work. And then, of course, there's the special role that central banks play in times of crisis, acting as a lender of last resort. When you think about the functions or the main areas of the Federal Reserve, some are probably very obvious and people think about those right away, such as conducting monetary policy, banking supervision. So the Federal Reserve supervises bank holding companies, state member banks, and foreign banks operating in the US. But different central banks have different powers over supervision. Some do, some don't. There's, of course, research and all the statistics they produce. And then two areas that are probably less well known, but are also critical, are the Fed's role in the payment system, as I just mentioned. They issue all the paper currency and distribute it around the world. So a lot of focus on making sure dollars get to where they're needed. They collect the checks deposited by banks. They process electronic credit and debit transfers. And on the wholesale level, they operate FedWire and FedWire Securities, which processes large value financial transactions. And then the final main thing that the central bank does is it invests the central bank's FX reserves. In the case of the US, our reserves are quite small. It's not a major part of the operation, but in some countries, this is a very large component of what a central bank does. And one special function of the Fed is They actually provide operational and investment services for foreign central banks that want to invest in treasuries at the Fed. So those are that's a brief overview of all the different aspects. Some probably well known, some probably less well known.
Nothing you said sounded nefarious to me.
Hopefully not.
Okay. I have a funny question to ask you. When you were at the Federal Reserve Bank of New York, did you get to see the gold?
Yes. And I highly recommend, if anyone's on a trip to New York, it's a tour that's perhaps not well known, but do go visit the Gold Vault. If you're an employee, you can actually go in the vaults. If you're just a tourist, you have to sort of stay outside, but it's still extremely impressive. And unlike for any one of you that's seen the Die Hard movie where they're trying to rob the gold under the Fed, there's a lot more security than appears in that Die Hard movie. So it is a pretty impressive operation.
Wesley, did you hear that?
Yes.
Okay. Okay. Thank you so much for that explanation. I want to ask you about inflation, because that seems to be the now risk on everyone's mind. And it's been a long time since we've had any meaningful inflation. I mean, really, we're talking about the Paul Volcker days in the early 1980s. So what are your thoughts on inflation risks? And could you explain, in your opinion, what causes inflation?
Sure. And I think this is a great question, and it highlights perhaps one of the challenges with the economics profession, which is that we don't even really agree on what causes inflation. So, and even within central banks, probably don't necessarily all agree. So I think that's a useful starting point. So in my view, I think there's two main factors that drive inflation. So the first is resource utilization, and the second is long-term inflation expectations. And so I'll spend a couple minutes on what I mean by each of those. So by resource utilization, I mean how much spare capacity there is in the economy. So this is primarily a function, and we think of this as primarily a function of how much spare labor exists, so the unemployment rate. But it can also be a function of resource utilization more broadly. And certainly we're seeing that now, that supply shortages in certain sectors are pushing up prices of certain goods. Now, when there's a large amount of spare capacity or a negative output gap, inflation tends to be muted. And conversely, when there's a positive output gap and no spare capacity, no resource slack, there's upward pressure on inflation. Now, if you look, this has been a very unusual couple of years, but by estimates of the CBO, so the Congressional Budget Office, the output gap will move into the most positive territory next year that it's been since the 1970s. So does this mean that inflation is going to be as high and pernicious as it was in the 1970s? And I think the answer to that is clearly no. And part of the reason is that now inflation seems to be less responsive to that output gap. So this is what we mean when you hear people say the Phillips curve, or the trade-off between slack and inflation, has flattened. It just means that we don't seem to get the same degree of inflation that we used to with a tightening in resource utilization. But that relationship is still there, and that's still a factor that is going to be putting upward pressure on inflation. Now, the second main factor, as I mentioned, is long-term inflation expectations. And this makes sense, right? So if everyone expects inflation to rise 2%, then businesses tend to raise prices 2%, and workers are going to demand a wage increase of 2%. And inflation expectations tend to be quite sticky, but they can change. It's difficult. And I would argue when they change, it's really because there's some regime change that occurs in the policy framework. So if you think to U.S. history, recent U.S. history, some of the most famous regime changes, if you think to the 1970s, again, that period where we had very high inflation, what happened? We had oil supply shocks, very large fiscal deficits funding the Vietnam War and the Great Society, the abandonment of the gold standard, so a huge shift in the monetary policy framework, and then Nixon's decision to not reappoint the current governor, who was an inflation hawk, and instead appoint someone who was an inflation dove to chairman of the Federal Reserve. And then subsequently, we saw another big regime shift when Chairman Volcker came in to head the Federal Reserve, and he had to raise short-term interest rates to 18% to convince America that the Federal Reserve was no longer going to tolerate high inflation. So you can get these shifts, but it is very difficult and usually requires a big change in policy, both on the monetary and, I would argue, sort of broader policymaking side.
When you mention resource utilization, I think about this term cost push inflation and specifically wage inflation. And that is something that it seems everyone is focused on now because, we do have all these job openings. People are not coming back to work, and it is causing some pressure on wages. Do you think that we are in this era of wage inflation?
So I think it is a really interesting question, and one that we're going to have to watch closely. So to your point, inflation, wage rates are going up. One of the things, the websites I like to recommend everybody check out is the Atlanta Fed Wage Growth Tracker. Really cool charts. They decompose the labor market by region of the country, by education standard, by, they cut the data lots of different ways. It's very interactive, and you can see the graphs. And one thing you will notice is low end wages are rising much faster than the higher end. And I think there's a real question about what's driving this. So as you note, lots of jobs are available, but the labor force participation rate, so the number of people who are actually working, is lower than it was before COVID. So is the reason for this because people are still nervous about COVID? Is the reason for this because people are generally pretty well off right now? If you look at household balance sheets, they're quite strong. Savings rates are quite high as a result of the stimulus checks and large uninsurance payments. And so perhaps there's a desire not to work at the current juncture, given some of the risks and maybe the undesirableness of some of these jobs. So I think this is the key thing the Fed is watching, is what happens to the labor markets in terms of the labor force participation rate and wages. And so I think it's too early to make a definitive call on that yet.
And on the long-term inflation expectations, what do you specifically look at to gauge that metric?
And so that's a great question, because you probably, in economics, we like to do this all the time. We use these terms, but then we don't mention that a lot of them are ones we can't actually observe and practice. So we can't observe long-term inflation expectations. We have to infer them by various metrics. We can't observe the output gap. So as I said, the CBO has these estimates of where they think the output gap will be, but it's a function of how strong growth is, as well as what they think the potential growth of the economy is. And so, these are all estimated. So, that's why I think economists get a bad name. There's always a lot of hand waving. But in terms of long-term inflation expectations, I think there are two measures that are useful and that the Fed looks at, and there's probably one more that the Fed looks at, but it's harder to get at. So the easiest one is the University of Michigan inflation expectations. So their inflation expectations 3 to 5 years ahead. That's a nice series. It goes back a very long time. You will see a small tick up, but I would argue if you looked at a long graph, you wouldn't say we're in any kind of different inflation environment now than we've been in for the past, 10 years or so. The other one to look at are market measures. So in particular, the Fed likes to look at the break-even rate on TIPS. So the one implied between inflation protected securities and nominal securities, or the 5-year forward inflation swap. So it's the inflation rate that the market is pricing between years 5 and 10. So if you think about it's trying to take out the near-term impacts that might be hitting inflation and really looking at what's that medium-term view of inflation. And there again, you will see inflation expectations have moved up. But I think they're still in the, they're still sort of, I would say, consistent with the Fed's 2% average inflation target. So
those two market measures that you mentioned, both of those are sub 3%, correct?
yes. And the thing that's somewhat challenging again, so the Fed has a 2% inflation target, but they like to target core PCE, so consumer inflation consumer inflation, whereas these financial instruments are based off the CPI inflation, which tends to run 3, 4, 5 tenths higher. So you shouldn't expect necessarily these market measures to be stuck at 2% to be consistent with a 2% inflation expectation, but maybe more along the lines of 2.3, 2.4, 2.5, which is around where they are right now.
Okay, thank you very much. But I do want to point out, you did not mention monetary policy in the context of inflation. And that's something that we've been hearing going back to the financial crisis, that monetary policy would have an inflationary effect.
Yeah, and I think this is an important point. So, in my view, monetary policy alone isn't sufficient to generate inflation. So it's sort of the opposite of the old Milton Friedman quote that inflation is always and everywhere a monetary phenomenon. I think we see that's not always the case. So when you think about the Federal Reserve conducting quantitative easing, so buying treasuries, what is it doing? It's buying the treasuries from the banks, and it credits the account of the bank. So the bank has this deposit that is sitting at the Federal Reserve. If there's no end demand for bank loans, then these excess reserves of the banks, don't go into the economy. They don't help create aggregate demand. You really need, private actors to do that. So one thing I think is very different, if you looked at a chart of base money, so that's the money supply that the Fed is creating, and compared it to M2, so the measure of money supply that includes the money created by the banking system. If you looked at that around the global financial crisis, you'd see this big spike in the monetary base from quantitative easing, but not much happened to M2. Whereas around COVID, you see this big increase in the monetary base and a surge in M2 as well. And so what was the difference? Why was it so much more impactful? I would argue so much more impactful this time around. Well, that's because we had very large fiscal stimulus and fiscal policy at the same time. So the fiscal policy put money directly into household bank accounts through the stimulus checks and unemployment insurance. Fiscal policy, through the Fed and through Treasury, giving loans and then grants to small businesses, put money into corporations. So that really put the money into the economy. And that's why you've seen a much more powerful effect this time around than during the global financial crisis.
And I'm having a flashback to Economics 101 course.
Sorry.
I'm thinking about the quantity theory of money, the MV equals PQ. And I've read a lot about the velocity of money. It just hasn't been there.
Yeah. And it's interesting. So if you were to plot the velocity of money, it's gone down so as more money, as monetary base has gone up, the velocity has gone down. And there are some arguments that we're just, part of the challenge or problem is that we're not measuring these things correctly, that with the financialization of the economy, that these numbers should be of vastly different magnitudes than they are. It gets kind of technical, but it is a sort of one of those things that you learn in, to your point, Economics 101, that doesn't seem to have any bearing on the way the world actually works anymore. And certainly central banks have not, they don't spend much time thinking about the monetary aggregates. They really spend much more time thinking about interest rates.
As we all do.
Yeah.
What about some of the contemporary criticisms of the Fed? There's been a number of things. I could list several of them, but I think one of the biggest ones that people think about is really just the failure of monetary policy to spur inflation and growth. And going back to QE after the financial crisis, that was sold to the public as a way to spur economic growth. And we really didn't get that. I mean, the growth that we got was in asset prices. Another one would be this notion of the Fed put. The Fed's got a floor underneath asset prices. It won't allow the markets to collapse. And that's why we have this saying, "Don't fight the Fed." So if the Fed is being stimulative, then you need to be fully invested. Then of course there's these unintended consequences of the monetary policy, and I mean I can name a number of them, like malinvestment, money going into things that it shouldn't be going into, with historically low interest rates. We have a lot of leverage in the system. Another big criticism of the Fed is that it fuels asset bubbles, because we're seeing the asset price inflation, but not inflation in the underlying economy. And then there's also the issue of inequality. So that's a lot that I've just said. You can touch on any of those criticisms you like. Have at it.
All right. And I would agree with a number of these. So I think, as I'll walk through these in turn, and I think in public, you wouldn't have many central bankers agree with many or most of these, but in private, many of them might. So first on the failure of monetary policy to spur growth or inflation, obviously right now, that's not the concern. Nobody's worried about the Fed not creating inflation. But to your point, that was the key concern we were talking about for like the last 15 years up until COVID, right? And so that was, I think, really the driving force behind the Fed's decision to adopt flexible average inflation targeting, FATE, as they call it, in October 2020. I don't think they quite knew how inauspicious the time was to adopt a new framework. But so under this new framework, I think the Fed was trying to create a regime change. As I said, it can be really hard to change inflation expectations. And I think they were worried expectations of inflation were settling somewhere below 2%. So they thought, we launch a new framework that convinces people that we're serious about 2% inflation, that will shift up these inflation expectations. So what did they say? They said it would average 2% inflation over time. So since inflation had been below 2% for so long, that meant they were going to, target an above 2% inflation target for a period of time. And then they also said, importantly, that they would no longer target deviations from full employment, but only shortfalls, meaning high unemployment could be a reason to cut interest rates for the Fed or do quantitative easing, but low unemployment in the absence of inflation would never be a reason to tighten monetary policy. So that was their big regime change. I don't think they realized that the world was going to shift so dramatically around them. Now, on the point about spurring growth, I think this is important. I think most central banks would argue that they cannot create growth. That's just not what they can do. The best they can hope to do is create a stable macroeconomic environment and stable financial sector environment that's conducive to growth, but that sort of policies that would generate lasting growth, such as structural reforms or deregulation or investments in human or physical capital, those all have to come from the government. And, that's not their purview. What is interesting is I think different central banks have very different views on whether they should, use the bully pulpit. Should they try to encourage their governments to enact better policies? The Fed is really on one side of that. You will never hear the Fed comment on government policies. At Powell's press conferences, he's often asked, do you think, the government should do this on the fiscal side or that? And he always says no comment, basically. But there are some central banks, like the ECB, that are quite explicit about what they think governments should do. So it's kind of a difference of opinion, really. Mm-hmm. The Fed put, I think that's a very important one. And certainly, I've been doing this for quite some time, in this business for quite a long time. And I would say repeatedly, we've seen that the Fed has validated the Fed put, stepped in to support financial markets. through interest rate cuts or later quantitative easing or launching special programs around the global financial crisis, around COVID, to stabilize markets. Now, in the Fed's perspective, they believe that monetary policy impacts the economy, the real economy, by impacting financial conditions. So it matters what happens to lending rates, but also in the U.S. economy, especially because we're such a capital market dependent economy. What happens to credit spreads matter. What happens to equity prices matter. So the Fed is looking at all these variables, and they run models. They have a lot of economists, and they run some big models. And these models all show that if financial conditions tighten, so equity prices fall, spreads widen out, the dollar strengthens, down the road, the economy slows. And so in the Fed's view, when they're easing monetary policy in response to a financial shock, they're doing it to help the economy, not to boost asset prices. But I think to your point, in reality, they're really doing both things. And it's become sort of and as you started out in the beginning of this conversation, everybody is focused on the Fed precisely because of this behavior has become so ingrained over time. I do worry that, going forward, maybe we get a risk of a more difficult trade-off. So, the Fed has been able to ease monetary policy in response to financial shocks because inflation hasn't been a problem. But if we're in an environment where inflation is above target, then it could be more challenging for the Fed to ease in response to a financial shock. And so maybe investors would be surprised that the Fed's not willing to exercise its put. But we'll have to see, because as you mentioned, every time they always do.
It seems like regardless of the intention that, why they're doing it, it doesn't matter the why. It's the fact that investors have been conditioned like Pavlov's dog to respond to not just the actions, but the words being spoken. And everyone's parsing every word by every federal official.
Yep. No, I fully agree. And so that comes then to your sort of this question about the unintended consequences, malinvestment, over leverage, asset bubbles, inequality. And I agree. I think these are very valid criticisms. And these are the ones I think where central bankers would push back on them in public, but in private might acknowledge that, our policies have pushed up asset prices. The top 1% of Americans hold more financial assets than everybody else. So, that disproportionately benefits, the top of the income distribution relative to the bottom. But I think their argument that they would make against this is, the cost of not acting, of leaving unemployment higher than it should be, or leaving inflation lower than it should be, would be worse than these unintended consequences. But, we don't know. We can't run that counterfactual. So, I do think it's an area that central banks should be doing more research on, to hold themselves honest and accountable.
Thank you very much. And that was very enlightening. And you did not disagree with the criticisms. Those will continue. An additional criticism of the Fed is that it's already done everything it can do. It's exhausted the toolkit. It's at risk of losing control. There are diminishing returns on all of this monetary policy. I can't disagree with that. The Fed funds is at the zero bound. It's been at the zero bound. Do we take it negative? And QE is not giving us the stated benefits. So what do you think about the risk that the Fed, will lose control going forward?
So I definitely worry about this. Right now, we don't seem to be in that environment, in that, as you said, even though interest rates are at the zero lower bound, that seems like it's going to change over the next year or so. But, we're always one macroeconomic or financial shock away from that. But I do agree that is a key worry. And it's a situation I would not be shocked to find us back in 3 or 4 years from now. So this problem of too low inflation, too low growth. And to your point, once interest rates are at the zero lower bound, what else can you do? We've had some central banks in Europe and Japan bring interest rates into negative territory, but there's a real question about whether that's negatively impacted the financial system, hurting their profitability, making them less willing to lend. Certainly, there seems to be a floor on how negative you can take interest rates. I mean, it is interesting that we've had this massive shock of COVID. The ECB, the Bank of Japan, they did not cut interest rates. So I think that highlights that they don't think there's a lot of room left to lower interest rates further. If they're not going to use it in one of the biggest shocks in our lifetimes, they're probably not cutting rates further. And then on the quantitative easing side, I think this is another important point. Central bank balance sheets have become extremely large. Prior to COVID, they were very large. And they've basically almost doubled in size since then. So, there is a real question. And here you will hear central bankers, and it's very interesting now. If you go back and look at speeches from 2011, 2012, 2013, central bankers would say, every X billion of quantitative easing is equivalent to a 25 basis point interest rate cut. They don't say that anymore. In fact, they're saying now, that they're questioning what the benefit of incremental purchases is on the economy. And so, that does raise the question, well, now the balance sheets are so large, central banks own a very large share of the sovereign debt outstanding in countries. And then, into some countries, they own a lot of the corporate debt outstanding. In places like Japan, they own a fair amount of the equity market. So, there is this question of, are they running out of tools? And this is precisely why I think the Fed launched this, their new framework, FATE, because I think they realized we have to do something to reset inflation expectations because our tools are losing some power. Now, this is not, you will never hear a central banker say they are out of policy ammunition because that would be like death. I mean, the financial markets would hate that. But I think they recognize it. That said, I think, if we find ourselves back in this world, I think we should expect central banks to continue to innovate and try to create new tools. That has certainly been the lesson over the past 15 years, all the new tools that central banks have created. And the reason is really simple. It comes back to the mandate discussion we started with. Central banks have been given a mandate by government. Their job is to have full employment and 2% inflation. And if they're not doing that job, they're going to do whatever it takes to try to achieve that, unless, the government changes what their mandate is. So I definitely see that as a challenge in the road ahead.
Okay, you raised the question, what is the point of QE, the asset purchases? And there are some who are very vocal in their view that this is being done to monetize debt. So it brings into question the independence of the Fed. Could we see a point down the road where, in light of these fiscal deficits with no end, this ballooning federal debt, and the Fed is the buyer of last resort? That is the debt monetization by definition, and in which case there is no independent Federal Reserve.
So this is a very good point and a very interesting question. If you asked central bankers in advanced economies, they would say absolutely not. We're not doing QE to benefit governments. We're not monetizing the debt. It is the case, if you look at where sovereign debt was in 2007 before the global financial crisis to now, in most countries, sovereign debt has roughly doubled. Mm-hmm. But interest payments on that debt are smaller now than they were in 2007. So it does have a very happy side effect that it really does bring down the debt servicing costs for governments and allows them to enact these massive fiscal programs with very little cost. It's also interesting, if you look at the history of emerging markets that have had hyperinflations, debt servicing problems, how do they usually get there? They usually get there precisely because they're monetizing the debt. And so why is it different in a place, when Argentina does this and, they do this and everybody takes their money out of the economy and sends it to Miami, puts it in dollars. And then when the Fed does it, and it's just because I think the Fed has a lot more credibility. So, in defense of central banks, I would say their view is they are independent. They're not doing this, to support the Treasury, though they will acknowledge that it does provide more fiscal space. And I think everybody over the past couple of years has heard central banks say over and over, we want governments to use the fiscal space. We want them to support their economies during COVID. So I think they do recognize there is this codependency here. Most governments have taken advantage of this period of low interest rates to term out their maturities. So it does mean going forward, even if interest rates increase, they're probably less vulnerable, but it is a risk. And I think this is the challenge. Debt has risen across the board. So on the sovereign sector, the corporate sector, and the household sector in virtually every country around the world. And so what happens if interest rates do rise? That's a huge headwind for the economy, for growth, for fiscal policy. And, if you ask central bankers, they'll say they're independent, they'll do what's necessary. But I think it is, I'm where I worry and where I think this could come to pass is if interest rates have to go up dramatically, that you get a very nasty market reaction. That tightens financial conditions dramatically. And then what do central bankers do? And so I think this is an interesting development, and pushed to extremes, thinking about some of the theories that have become more popular in recent years, modern monetary theory, that you don't really need an independent central bank. Governments should just be in charge of the monetary as well as fiscal strategy. Those are some very dangerous ideas. And again, thinking back to what could shift inflation, well, you need a regime change, and something where the Fed is no longer independent or central banks are no longer independent, that would certainly be a regime change.
And even more than the impact on financial markets, I mean, if interest rates were to normalize, what would that do to our budget? I mean, it would seem that if we got back to normal interest rates, the debt servicing costs would just crowd out all discretionary spending.
Yeah, no, it's a real issue, and it's also an issue for households and corporations who also have taken on a load of debt. And so, one of the things I think is interesting, if you look at the last cycle, when interest rates got to 2%, 2.25%, not high levels historically, we started to see the housing market roll over. Interest rate sensitive sectors of the economy have just, they've become much more sensitive because debt levels are higher. So this is going to be a challenge.
Do you have any opinion on Reinhart and Rogoff? Carmen Reinhart and Kenneth Rogoff's views on debt to GDP and economic growth?
So I think, some of their original research that showed like there's a certain level that really is pernicious. I think we've learned that sovereigns can carry more debt. So, 60% of GDP isn't a magic level. That said, I do worry, this new speak that is common amongst the economic establishment and amongst central bankers that, well, we really shouldn't worry about debt to GDP anymore. We should just worry about financing costs, is also a little naive because they can change dramatically. So my career has really been spent looking at sovereign debt crises. So when things go wrong, and it's that kind of thinking where things really can go wrong. So yes, financing costs are low now, but that can change. And when it does, it poses a real burden. And if you think about it, by running large debts now, we're basically saying we're valuing this current generation more than future generations. And is that really fair? Is that really how we, want to do things? And I guess even more troubling, if you look at the CBO, Congressional Budget Office, some of their longer term projections, because of aging populations and the impact that's going to have on healthcare costs, Social Security costs. not that many years out, 10, 20 years from now, those programs are going to take up all discretionary spending in the economy. So our fiscal challenges are only going to get worse from here. So adding, I guess during COVID, it was probably the right idea to add a lot of debt and do the big fiscal programs. The challenge is, in good times, we also have to be willing to do the opposite, which we never really are.
No. Okay, Idanna, enough about the Fed and central banks. Let's talk about the U.S. dollar, and that is something that you have a lot of expertise on. In light of what we've just discussed, fiscal deficits, ballooning debt, what do you think about the risk of the U.S. dollar losing its place as the reserve currency of the world?
So maybe I'll answer that in two parts. So first, on the dollar currently, and the sorts of things that we look at to value currencies. In our view, we think the dollar is extremely overvalued here. Things we look at are real interest rate differentials. But if you look at the real interest rate differential in the U.S. versus any other country, U.S. real interest rates are much lower than other countries. And that reflects that although all countries are experiencing very similar pressures that we are here, inflation in the U.S. is much higher than elsewhere in the world. So with nominal rates zero everywhere, your real interest rate is really determined by your inflation rate. So, by that metric alone, the dollar should be much weaker. The other things that are happening is the current account deficit is starting to grow. And that makes sense because the U.S. economy has been growing so much more, quickly relative to the rest of the world. Our fiscal spending, our fiscal deficits. All countries employed a similar situation. They spent a lot around COVID, but again, the U.S. really outdid itself. It was really special in that regard. So that's growing the current account deficit wider, which is another thing we think should weigh on the dollar. And then, the U.S. was sort of one of the first economies to emerge from COVID because of its success with vaccinations, really was a growth leader. But as other parts of the world are just starting now to open up, think about Japan, some other parts of Asia, that we might see a growth rotation away from the U.S. towards other areas, which would be another factor that might weigh on the dollar. Now, thinking about the reserve currency status of the dollar, I don't see that as something that's going to change in our sort of professional lifetimes. That's one of the things I feel most certain about. Because when I think about what determines the reserve currency status, why in a crisis does everyone want to hold dollars or treasuries? It's because we have very deep liquid capital markets in the U.S. We have a strong rule of law. We have generally predictable policy making. So in a time of crisis, it generally seems like your safest bet is to put your money here. The other point I would make is even though we've seen other reserve currencies come into existence, so like the euro with its launch in 2000, the euro has become a reserve currency, but it really hasn't dented the status of the dollar. So I'm not terribly worried about the dollar losing its reserve currency status anytime soon, unless we embark on, really foolish policies, which I hope we wouldn't.
Well, to add to what you were saying about why do people want to hold dollars? Yes, I mean, deep capital markets, strength of the economy, the rule of law, and I would add military superiority. But it does seem like some of these things are maybe questionable going forward. But my question would be, where else would you go if not the U.S. dollar? The euro, no. The yen, no. The Chinese yuan, maybe.
Yeah, so I think that's also the other argument in favor of the dollar in a room full of unappetizing entrees. Maybe eating the dollar isn't the worst thing. And when I think about the rise of could the RMB could the yuan become a reserve currency? I think if it did, it would be one of the best things that happened to the global economy, because it would mean that suddenly we had open capital markets in China. We had a convertible currency. We had predictable policy making, policymakers who actually spoke to markets. Clear rules and regulations. We don't have any of that right now, which is why there may be reasons one wants to invest in China, but not because it's where you want to put your sort of safety, your money for times of stress. So, as I said, I think, and if that were to occur, it's going to occur over a period of time. I think you have to imagine at least another 20 years before you would get to a place like that, if you ever get to a place like that.
Okay. All right. What about gold? First Eagle has always been known for its allocation to gold. What are your thoughts on gold here?
Yeah, so I think maybe this conversation has helped illuminate why we think gold is a very useful potential hedge in portfolios. One, because of some of the negatives facing the dollar and facing sovereign bonds more generally, given very low yields and very high debt levels. But there are other reasons as well. So one of the things that we like about gold and why it's a nice hedge for our portfolios is if you look at the correlation of gold to the S&P, it's basically zero over time. But then in times of stress, when you get downturns in the market, the equity market, gold has a negative correlation, and the correlation becomes more negative the worse the performance of the S&P. So a very nice hedge characteristic. The other thing is, when we think about what's the opportunity cost of holding gold, it's the real interest rate, as I said. But real interest rates are negative now. So you don't even have the opportunity cost anymore. And then finally, you have a very long history of gold. You can look at the data back 800 years, 1,000 years, and it really has preserved its value against various measures, like some sort of basket of consumption. It's really, and because gold bars gold doesn't deteriorate. If you had a gold bar 800 years ago, you'd still have a gold bar today. So it really does have that stable value that I think is useful, and that's why we use it as a potential hedge in the portfolios.
Would you care to comment on crypto and its viability as a alt currency or the digital gold?
So it's definitely not my area of expertise, but I think so. It is interesting, right? When you think about, do crypto assets offer this long-term store of value? They're only 5-10 years old. We just don't have the track record. Moreover, they're extremely volatile, so we don't really know what that store value is actually worth. I think Matt McLennan, who's the head PM at in Global Value, he likes to say that Bitcoin is a potential option on gold. Maybe it's a potential digital option on gold, and that over time, if it is successful, maybe it could be worth a lot more because it's it isn't priced quite like gold yet. That said, it's also possible it won't exist 10 years from now and it'll be worth nothing.
Right.
So I think there is this uncertainty. In addition, you have the environmental costs associated with and one of the things I think, and maybe this is a topic for a whole nother conversation, but I think we're going to see central bank digital currencies in the next 5 years. All central banks are going to have them, and it'll be interesting to see what their introduction does in terms of either promoting the use of crypto assets or sort of displacing crypto assets that are out there.
Thank you so much for that. So, there are so many macroeconomic factors, and we've touched on a number of them. How do you put it all together? How do you focus on what's important? What is important to you, and what is the noise?
So, that's a very good question. I think one of the most important things to note or to mention that people always ask me about, central banks have the same information we do. Yes, they have a lot more PhD economists working on these questions, but they don't have any special insight or special information. And I think that's very important in the world we're in today, where, the past year and a half have been unique, to say the least, right? We've had this exogenous shock driven by the coronavirus, something that we may never see again in our lifetimes. We've had an unprecedented, you'd have to go back to sort of World War II to see this unprecedented fiscal stimulus. And then starting next year, it's going to be withdrawn in the US. Other countries have already started. So huge swings in policy like we've never seen before. The world has evolved these supply chains, right? We've, I think, become aware now of how dependent we are on this sort of just-in-time manufacturing, and how missing one part can cause the whole chain to break down, and that, reopening a global economy is extraordinarily difficult. And then the other unusual thing I think we have going on right now is very high savings rates. It's true in the US, but it's true globally. And so what are people going to do with that money? Are they going to keep it, or are they going to start spending it? So huge factors of uncertainty. So I think in a world like this, an environment like this, we have to be very humble that we really don't know what's going to happen. We have never seen any of these things in our lifetime. So I think we have to, anyone who's too certain, I would be, a little skeptical. But that does mean that we have to constantly evaluate incoming information. We have to be willing to adjust our priors. We can't be dogmatic about what we think will happen. And so then, in thinking about, but we can't be reacting to every little piece of news and just being in a frenzy. So when I think about what's sort of my true north, and what do I think about our sort of first principles, if you think that the Fed believes its neutral policy interest rate is 2.5%. I think it's probably a little lower, maybe around 2%. But let's say it's 2 to 2.5%. That means the neutral 10-year yield, treasury yield, should be, 2.5 to 3%, which implies real yields. If the 2% inflation target is valid, that real yield should be somewhere 0 to 0.5%. And that's, while low relative to history, is some way above where we are now. So I think for me, the direction of travel is clear. We're going to a higher interest rate regime, still low in the sort of big, scheme of things, but we're going to a higher interest rate regime. The question is really the speed of travel, and it's going to be impacted by these very big changes that are hitting the economy. And so what that also means is I think we should expect a lot of volatility in asset prices, and in Fed speak. As you said, everybody's, listening to what the Fed is saying. And that's because they're evaluating the same information in real time as it comes in. So what's happening to COVID, what's happening to the efficacy of vaccines, what's happening to supply chains as they try to reopen, how much of the fiscal tightening are we getting next year? So they're doing the same calculations that we are. And so, I think we know the direction we're going in, but expect a lot of volatility around that.
Now, First Eagle Investment Management as a shop is known for rigorous bottoms-up fundamental analysis. How does First Eagle incorporate macroeconomic views into its portfolio management?
Yeah, so I think, that's a very good point. The first thing is, and people sometimes say you're bottom-up investors, why do you have a macroeconomist on the team? Or 3 in our case. And the reason is, we are long-term investors. So we generally, hold positions maybe 10 years. There's a lot that can happen in the world over that period. So we want to think not necessarily about where is GDP going to be next quarter, but really what are the big picture trends that are going to be very important for the economy and markets. We also recognize, and certainly I think the situation we're in now, we recognize that the world is extremely uncertain. And so to deal with that uncertainty, you can deal with it through security selection. So again, really picking businesses that you think can survive and thrive through the medium term. but also through price, purchasing assets at a discount to what you think they're worth, as a buffer for the environment being different than you expect it to, the gold as a hedge for the portfolio, that in really bad times, gold is a very useful hedge for the portfolio. And then the last thing we do is we do hedge currency exposure where we think, when we think it's necessary. So if we think a currency is particularly overvalued, we'll hedge out that currency risk. And if we think it's undervalued, we'll take more of that currency risk as another way of trying to protect from very large swings in the macro environment.
Idanna, you have been so gracious with your time today, and I want to honor your time and just I have one final question for you. Are you touched upon the rising interest rate regime, and I think everyone agrees that is the future. Interest rates have to go up from here at some point. So given that, and yes, with the caveat that it can ebb and flow, it won't be a straight path to get there. But given that, where do you personally see income opportunities going forward?
So that's a good question. And as someone who invests in sovereigns, I would like to have some more income opportunities to to choose from. I think so. As I said, if we get to an environment where interest rates settle, treasury yields settle back to 2.5%, 3%, and you get a spread over that begins to offer some sort of income yield in investment grade or high yield credit. When I look out globally, it is interesting. The rest of the, and this is the nice thing. If you look globally, the rest of the world is not in the same place that the United States is. So there are a number of companies who pay very nice dividends on some very nice businesses. So those can be very interesting opportunities. And in the same way that the U.S. is dealing with rising inflation, other countries are dealing with rising inflation as well. And markets have begun to price in a lot more in interest rate hikes. And there have been a lot more interest rate hikes taking place, especially in emerging markets. And so yields have started to go up pretty dramatically. And so there are some very interesting opportunities out there now. The challenge with that is, there are sometimes there's sometimes a lot of risk associated with investing in some of these jurisdictions. And that's why, we spend a lot of time looking at companies and countries very closely, because as you venture further afield, that due diligence really is helpful. So I think those opportunities do exist now, and there should be more going forward. And if we get this volatility, which I think we will, that's going to even, open up some more interesting avenues.
Well, Idanna, I want to again thank you. You have been so gracious, and I feel like I've been sitting under a professor and going back to school. Everyone who is listening and who will watch the replay will greatly benefit from hearing from you and gleaning from your expertise. And you are always welcome anytime.
Thank you.
And I wish you a wonderful weekend.
Thank you. You too.
Thank you. Cheers.
Bye-bye.